Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, September 18th, 2025. Hope everyone's having a great week. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macros. So, today's key macro question is: did the Fed signal enough to adequately support Paradigm C? Our answer: yes. In our view, the Powell Fed truncated its fifth major policy mistake by easing modestly at yesterday's comically non-committal FOMC event and hilariously evasive Powell presser. That the Fed begins supplying the U.S. economy with the easing required to counter cyclical and structural headwinds to the labor market, with inflation still above their arbitrary 2% target, represents a step in the right direction from our data-driven perspective. While there is still plenty of ground to cover, we steadfastly believe that ground will be covered over the next few years, with 2026's key personnel changes representing a far more significant step in the direction of properly acquiescing to imminently observable regime change regarding inflation and fiscal policy dynamics. Said simply, if the Fed does not bend the knee, it is highly likely that the U.S.'s K-shaped economy will grow more K-shaped over time due to the ongoing non-recovery in housing, the ongoing non-recovery in small business activity, the ongoing economic malaise among low to medium income households, and the negative demand shock for labor stemming from AI, among other factors. Reminder: K-shaped economies have significant consequences at the ballot box. Cough, cough, democratic socialism. Cough, cough, democratic socialism. Gotta clear my throat here. Yesterday, we indicated that the three key dynamics to watch for in the September FOMC event, we indicated that there were three key dynamics to watch for at the September FOMC event. Regarding number one, yes, the median FOMC members sped up their projected path to return the policy rate to a neutral setting of around 3%. No, we do not think it's appropriate for investors to summarily dismiss Dr. Stephen Moran's politicized dot, because an erosion of Fed independence is where this is ultimately heading. Skate to where the puck is going. Regarding number two, while the median FOMC member did not decrease their estimate of NAIRU, which would allow them to ease faster and in greater quantities, they did signal greater uncertainty surrounding their long-term unemployment rate forecasts. We can only speculate as to why, but we can have a high degree of confidence that AI is a factor based on recent commentary from Bank of America CEO Brian Moynihan and recent data from the New York Fed. And finally, regarding number three, the median FOMC member neither lowered their estimate of neutral nor increased their long-run estimate of inflation. We believe the dot plot will signal a lower neutral rate estimate by December of 2026, which will contribute to durably negative real floor Fed funds rate pricing by then. While the Fed may never officially abandon its arbitrary 2% inflation target, those of us who understand the role the monetary authority will be forced to play in this foreturning know that its increasingly loose commitment to 2% inflation as the definition of price stability signals the inflation target is changing in a manner that is unlikely to alert the frogs being boiled alive in the pot that is the Treasury bond market. And recall that we've been saying the Fed has a very delicate balance it's a tightrope right here. It's a fairly delicate balancing act. You can't unmoor inflation expectations by, jump conditioning to a 3% inflation target, which would obviously freak the market out and get it concerned about 4% inflation, 5% inflation, 6% inflation. That's not a productive use of political capital. What is more, but the Fed also obviously can't just stay, staunchly committed to this arbitrary 2% inflation target, given everything that's happening with the economy and fiscal policy, of which it contributes to. And so ultimately, the Fed has to guide the market in a credible manner towards accepting a higher trend equilibrium level of inflation, which will ultimately allow it to focus more on the growth side of its mandate to address some of these distributional issues in the U.S. economy that are obviously having increasing political ramifications. Look at last week, as a clean example of that, in our opinion. And so this stuff's not going away. You can argue whether the Fed should be X amount of independent or Y amount of independent, but the reality is the Fed's track record, which is a terrible track record in terms of producing good outcomes for the American public, means its independence is going to get eroded anyway. You can disagree with the party that's causing the erosion of independence currently. You can disagree with the party that caused the previous erosion of independence back in 2020 and 2021. It doesn't matter what your political views are. Who cares what your political views are? The market certainly doesn't care. I certainly don't care. What matters is, where is the puck going? The puck is going in a direction that forces the Fed to be more creative and more supportive for the economy, and most importantly, more creative and more supportive of the Treasury bond market, because ultimately that geopolitically driven supply and demand imbalance in the Treasury bond market that we identified back in the summer of 2023, that the Federal Reserve was supporting at the margins from the fall of 2023 up until the Orange Man came back in office. The Fed was doing exactly what it was supposed to be doing in a four-turner regime. And it stopped this year. And ultimately, we think it's going to be forced to get back on that horse over the medium to long term. And in our opinion, that represents substantial right tail risk to risk assets and gold over the long term, and substantial left tail risk to the U.S. dollar and Treasury bond pricing if they do it in a manner that alerts the frogs being boiled alive in the pot. That is the Treasury bond market. If they do it in a manner that does not alert the frogs, then this will end very positively. I'm not saying it will end positively, but I would say we are way too early in paradigm C, in our view, for you to assume that it's going to end poorly. Because anyone who thinks it's going to end poorly is probably someone who has not participated in paradigm C since we altered the thing back in April. And those people who have not participated in paradigm C, to the extent that we continue to be right, will be forced to buy at much higher prices, because we're not going to sell it to them until paradigm C is over. So be aware of that. So transitioning to our 42 macro dashboard here, is always a wrap up of the question from our community. This is a fun one regarding labor force participation. Says, hi, Darius. I was going through the September macro scouting report, which was always amazing. Thank you for the kind feedback. So much signal. I watched it twice and probably will watch it again. Also, thank you. Thank you for doing those, because I know a lot of work goes into it. It certainly does. And I'm happy to do it because, one, this labor of love, I want to keep our client base, the team members on Team 42. I want to make sure they're as close to the vanguard of what's changing at the margins with regards to the 6 cycles that matter to markets: growth, inflation, monetary policy, fiscal policy, liquidity, which is kind of the net of all those 4 cycles, and then the positioning. Those are the 6 things that matter to markets. Everything else is noise. And so we want to keep our client base as close to the vanguard of what's changing at the margins with those cycles, because what changes in those cycles is what causes market pricing to change, what causes momentum and dispersion across asset markets to change. If nothing changes in those cycles, then the momentum and dispersion of asset markets will be like an object in motion. It'll just continue to go wherever it's currently headed. So just be aware of that. So that's why we do so much work. The September macro scouting report was 175 slides. I capped myself at 2 hours. The goal was to get it done in 90 minutes in terms of the webcast, but I capped myself at 2 hours when they're that long. But generally speaking, they're not always that long. They're usually around 90 minutes in terms of the webcast, but that was a long one, given how much stuff is happening right now. You can bury your head in the sand and pretend it's not happening with regards to the erosion of the Fed independence or the new tariff regime or obviously all the other stuff that's happening in our country from a political perspective, or you can do the work and profit from it. We're doing the work and profiting from it, and helping thousands of investors around the world and our global investor community profit from it. So getting back into the question from one of those thousands of investors, I was hoping I could ask you a question about slide 61, which the Fed's current reaction function on labor market conditions fails to incorporate the structural damage done to millions of would-be workers because of failed neoliberal economic policies. I listened to this a few times, but didn't fully understand where did those workers go, that they are no longer counted towards labor force. Apologies, this is very obvious. I'm just understanding it. As always, thanks much for keeping me on the right side of market risk. I appreciate you and the entire 42 team. So thank you again for the really kind of compliment. Let's just go straight to the slide, make it easy to explain this. So what we're showing in this chart in the first panel is the employment to population ratio, the prime working age employment to population ratio. That's for ages 25 to 54. Those are the people who make it spend the most in the economy, coincidentally. That ratio peaked at 81.9% in April of 2000. And so it's obviously declined since then. It's been cyclically, or it had been cyclically rising. Now it's back to cyclically declining again. And it's sort of back on this long-term trajectory that's obviously not great. It implies there's something structurally broken in the economy. Now, our estimation of this is we have a bunch of failed neoliberal economic policies. That's not to say that all the neoliberal economic policies failed. They did not fail. The GDP is much higher. Corporate profits are much higher. The stock market price is much higher. But the reality is those are no longer politically acceptable outcomes. This is a country that is now hyper-focused on both sides of the aisle about the distributional aspects of this stuff. It's no longer about getting GDP up. It's no longer about getting corporate profits up. It's no longer about getting the stock market up. The people at the ballot box care about their livelihoods in ways that are no longer supportive of some of the failed aspects of the neoliberal economic policy agenda in terms of globalization and prioritizing profits over humanity, people. And we can get into, I don't want to get into a long political discussion here because it's neither here nor there. But what is here is the fact that those people are no longer in the workforce. If we had the same level of prime working age population, employment to population ratio as we did back in April, the peak of the all-time high in April 2000, we would have roughly 1.6 million more workers. So right now, these people are no longer, they're not in the labor force, because if they were, they would be counted towards the unemployment rate. In fact, the unemployment rate would be 5.2% if these people who don't have jobs currently that still exist, that are human beings, were in the labor force. They're just not in the labor force because their entire town used to do something and now China does it. That how many towns across America have, they can raise their hand and say, yeah, we used to make furniture here. We used to make planes here. We used to make this here. We used to make that here. And we no longer make any of it here. We're now all on opioids because there's no economic activity. How many towns in America? I mean, this is like, it sounds political, but it's not. This is what happens in fourth turnings. The underlying cancer in the economy that causes all the problems in a fourth turning and all the solutions to the problems is inequality. It's inequality. Inequality is the thing that topples civilizations. Go back and study any civilization in history. It's the thing that topples civilizations, and it's the thing that causes the kinds of the kind of fiscal and monetary policy outcomes that we've been coaching our investors in our global investor community to expect for over 2 years now. And obviously they've profited it tremendously from that, in terms of participating in KSN or Dr. Mo in the asset classes that we've been telling them to focus on: stocks, gold, Bitcoin, things of that nature, as opposed to, scaring people into buying treasury bonds or the US dollar or other lower beta asset classes that, simply just don't, the conditions of which why you would consider these things in your portfolio construction no longer, in our opinion, exist. So we'll wrap it up there. Hopefully that was helpful. Darius Dow here, presenting our macro minute for Thursday, September 18th, 2025. I know these are not a minute, but guess what? There's way too much stuff going on for these to be a minute. So if you want to TLDR your investing, you're going to get TLDR investing results. So be aware of that. Cheers.